opportunity is in your view?
I do. I mean, we've been saying this for some time, but you don't want to play defense anymore. It's time to play some offense, and I think that you want to be more exposed to stocks than bonds that really aren't as attractive to us right now at these low yields.
You have some interesting holdings. I have to point out one that's been in the news, and that's Carnival. It's your third biggest holding as of the end of February. So why hold on to that one?
Yeah, well, we actually bought it after the Concordia sank, and just really it allowed us to get into a stock at a very reasonable price compared to where it once was. Now you've got a lot of things working for them. They're going to spin off, $3.5 billion of free cash flow that's going to pay not only for the dividend, but it's also going to pay for any capex needs they have for new boats, which at this point aren't many. So it's a really nice way to pick up a 3.5% dividend yield and a nice duopoly with Royal Caribbean.
So this intrigues me. So you obviously don't worry so much about headline risks. You're looking more at some deep financials in terms of what the growth is for these companies.
If the headlines come out and they're negative, it gives us an opportunity that are long-term oriented, 3 to 5 year type of track record to get into a duopoly, such as a company like this. So it really works out nicely for us.
What do you think about small cap versus large right now?
Small cap's made a very good run, obviously. It's been the right place to be, and luckily that's where we pretty much were positioned in all of last year, which really helped our returns, and we continue to have a large exposure there to small caps.
So give me an example of another small cap company that's in the fund that you like that's got a compelling story.
One that I like is Sotheby's. So this is another duopoly, and we were able to take a look at that with Christie's. So this is a 250-year-old company that I think is going to do quite well. In the last 5 years, this is the first time that they've been able to raise commission rates along with Christie's. So it shows you the strength in their underlying business. But it's not a demand story; it's a supply story. So as long as there's death, debt, divorce, and discretion, which I think there will be, art's going to come to the market, and this is going to be a good deal for them.
Yeah, I think you're guaranteed you're going to have all that. What about bonds? You worried about a bond bubble?
Yeah, I actually am. I think that basically we're going to continue on this, or the Fed's going to continue on this $85 billion a month bond buying spree until unemployment gets to 6.5% or something like that. So I think we think it will eventually come back. You look at where rates were in 1981 to where they are today, 2% on the 10-year. It's getting a little bubbly for us, and we think stocks will be a better place to be.
So what does that mean for the fixed income that you do hold in terms of duration?
We want to stay shorter, and we're not. When we take risks, we can buy 10% of our fixed income portion in less than investment grade. So when we go through our equity research efforts, when we're looking at these companies, we also can find some interesting fixed income opportunities to try to outperform on the fixed income side.
So in some cases, do you own corporate debt as well as stock of an individual company?
That's exactly right. Yeah, if we've done the work and we think it's going to work, and we're taking risk, but we know we're taking that risk. That's the key. So we think it's going to work well, and on the bond side also.
What was the smartest stock holding you had last year? What one really paid?
Actually, it was a company called 3D Systems that we think is going to continue to do well. This is the leader in the 3D printing business. That the whole industry is going to grow at 23% compounded over the next 5 years, and this is the 800-pound gorilla in that industry. So very excited about the future, and it's actually pulled back. It was at $15 last year and closed at in the mid-40s or something like that. Now it's pulled back to 30. Great opportunity for people to get involved with that one now.
What's the biggest risk in terms of stocks that you're worried about right now?
In terms of, I guess, just the valuations, a lot of things have really picked up recently. So even on the S&P, you're looking at a multiple that's gotten closer to 14.5 times. Now you got to think that the S&P can do 15 times $108 in earnings, and next year I think you're looking at 15 times maybe $115 in earnings. So I think when you look forward to next year, you're looking at 1725 on the S&P. So even though valuations are getting a little bit stretched, I think there's plenty of room left to go, and certainly better than unattractive bonds.